Welcome everyone to Vested Interest. This is Shane, and in this video today we are going to take a look at Lamar Outdoor Advertising. This is a recent addition into the Berkshire Hathaway portfolio, Warren Buffett's portfolio there. I know he's kind of stepping back away from it, but I believe he still does have some input on what's going on there. May not have been one he bought, but it was, according to their most recent 13F, a new one for Berkshire Hathaway. And also a suggestion from Jeff here. Commented, impressive portfolio. That's why I subscribe. Could you please do a video on Lamar Advertising, ticker LAMR? As always, thank you. And this is a REIT out of the real estate sector. Now, this is the criteria we will be going through. This is the vested interest stock screener. It must make it through 5 of 8 to make it on my watch list. And if it does make it on my watch list, that does not necessarily mean I am buying. It just means out of the thousands of companies out there, I am interested in doing more of a deep dive, looking at their financial statements, their income statements, and doing a discounted cash flow analysis on the company. Now, if you want to know more about this company, check them out on their homepage, lamar.com, LAMAR.com. That is their homepage where I pulled this information from. Founded in 1902, Lamar Advertising Company, ticker LAMR, is one of the largest outdoor advertising companies in the world with over 360,000 displays across the United States and Canada. Lamar offers advertisers a variety of billboard, interstate logo, transit, and airport advertising formats, helping both local businesses and national brands reach broad audiences every day. In addition to its more traditional out-of-home inventory, Lamar is proud to offer its customers the largest network of digital billboards in the United States with over 5,000 displays. So this is not one you're going to see, on your TV whenever you're watching TV. It is one you're going to see when you're out in the airport, when you're out driving around on billboards, those bus bench seats that you see, buses there you can see. Some of them, whenever you're in a train station or bus station, the ones on the walls that you might walk by. And you can see here this map, all the different locations that they have up in Canada and in America primarily. And again, bulletins, posters, digital ads, JR posters, junior posters, wallscapes. So you might see a building with the advertisement on the side of a building, benches, shelters, bus and rail routes, airports. So again, it's not the ones that you see at night advertised on your television, those type of ads. It's the ads that you see out in the world, primarily billboards, I think is really their bread and butter, but also, like I said, buses and that sort of thing. I was actually surprised it was a REIT, but it is out of the REIT sector there, so it is a real estate REIT company. Lamar Advertising Companies, who we're talking about, ticker LAMR, again out of the real estate sector. It is a REIT. Closed off the day at $120.65, down 0.6% on the day. Not a big drop, but a drop nonetheless. 52-week range, $99.84 for a low, as high as $139.88. It is not quite within 15% of a 52-week low. It needs to drop to $114.80 or lower to be in that range. So it's getting there, but not quite. Market cap of $12.212 billion, a beta of 1.39. So this company is more volatile than the overall stock market. Might be able to use that volatility to your advantage. Buying on the downturns whenever it's within that 50. I like to buy whenever a company's within 15% of a 52-week low, preferably setting a new 52-week low, but right in that range is where I like to start my positions. And then, like I said, a company like this that's real volatile, you can buy on those downturns and then hold on the upswings. Price to earnings PE ratio, $28.06 per share. Seems a little elevated to me, but if it's growing fast enough, that doesn't necessarily mean anything. EPS, earnings per share, $4.28. Earnings date, November 6th. So we are a couple months away from that, a few months away from that. For a dividend, $6.20 per share. I believe this one is a quarterly payer. We'll see that here towards the end. Nice starting dividend yield on this one, 5.11%. Typically, REITs do have pretty nice dividend yields. This one is no exception. Ex-dividend date, June 16th. We are past that. Looks like they paid out on June 30th. So you would be in line for the next dividend, but you're going to have to wait a couple months to get it, or actually it would be next month. 1-year target estimate, $130.20. So they don't see it getting quite back to its 52-week high here, about $9 and some change off of that. Jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. It is a quick check. And to do that, we look at their 5-year dividend yield average, 4.11%. We compare it to its current 5.11% over here, same number, 511. And since it is higher than their 5-year average, that actually speaks to some undervaluation on this one. Maybe why Berkshire Hathaway bought it, right? Now, I don't like this. Payout ratio is above 100%, 137.53%. But typically, I like under 75%. But let me preface this with a big but. This is a REIT. So it is not uncommon for REITs to be above 100% payout. By law, to get the tax advantages, they have to pay above 90%. So typically REITs are above my 75% rate anyway, but this one a little above that, even at 137, which means they're doing something else. And typically that's issuing shares. So a lot of times these REITs do dilute you as a shareholder when they're issuing more shares to cover the elevated payout ratios. But they're rewarding you on the back end with a high dividend yield. So there's a trade-off there, right? You're gonna use, if this you're an income looking for an income from your positions eventually, this would be a good one to take that trade-off for the lower, or I'm sorry, the depreciation in stock, right? As they issue more shares for the higher payout ratio. Again, there's a trade-off there. Free cash flow, let's look at that one. I like growing free cash flow. Companies can do some things with that. They can pay down debt, make acquisitions, reinvest back into the company. So in this case, they buy more space to put up billboards and that sort of thing. Buy back shares, which this company does look like they do that. We'll see if they buy back more than they issue. Pay a dividend, which this company does, and raise it over time. Keep some of that even cash flow on the free cash flow on the balance sheet as well. We want a company to be able to do all that. So we want growing free cash flow, or at least I do. Going back to December 2022 here, 614 million. 2023 looks like a downturn, 605 million. 2024 back on the rise again, 748 million. Trailing 12 months, which again does include a few months in 2024 still, 3 or 4 months there. Still, we're into August of 2025, so about 4 months of 2024 numbers in the trailing 12 months. 722. So it looks like they're going to beat 2024 numbers. So short of the downturn in 2023, looks like for at least the last couple of years they've been raising that free cash flow. Now, as I mentioned, they are pulling shares out of the market. 10 million in 2022, 5.9 million in 2023, 2024, 5.3 million. So far, trailing 12 months, they've pulled the buttload out, 157 million. So they are very aggressively buying back shares in 2025 here. Jumping over to stockanalysis.com. I am not affiliated with stockanalysis.com or Yahoo Finance, which was the previous one. Just 2 sources I go to. I do recommend 2, if not 3 sources, so you can make sure the information you are looking at is accurate and up to date. And you don't have to use the sources I like. You can pick any sources that you want. Again, just don't blindly follow one source. Sometimes information is wrong. Sometimes it's not updated. Now, they have 5 analysts that have taken a look at this. They call it a consensus buy. Low estimate of $119, which would be 0.4% decrease from where it currently sits. So not much further drop from where it currently sits was their estimated low. Average estimate of $134.20. That's pretty close to what we saw with Yahoo Finance on the previous page over the next year for their estimate. And that would be a 12.32% increase. High estimate of 160. That would be a new 52-week high, and that would be a 33.92% potential upside. Now, looking at statistics, I like to look at return on capital employed. I like 10% or better here, so they're not quite there. 9.18%, not quite there. They did not have forecasted EPS growth or revenue growth, so I don't like that. I'd have to go look for another source to see what exactly is going on with their forecast there. But I like 5% or better typically here. Now let's look at their dividend history. Quarterly payer, again, payout ratio is well above 100, 143.43%. Now dividend growth, very aggressive, 20.59%. So you pair even if it's not sustained at this, double-digit dividend growth. So if you pair that 5% dividend yield with a double-digit dividend growth, that is very, very nice. Growth of years, they're saying 1 year. We're going to check that here in a minute. I think it's been longer than that. Buyback yield is negative, but not very far off from turning positive. Maybe that's why they've gone aggressive with buybacks. 0.07%. So not really that bad compared to some others that we've seen out there. Shareholder yield is positive at 5.06%. They do pay out like most companies, March, June, September, December timeframe. Going back in time here, it looks like December 2022, they were paying $1.50. Now, March of 2023, they actually had a dividend cut. See that? Down to $1.25. So I don't like seeing that. That's within the last few years, down to $1.25. Maybe they did it because their debt was out of control. You'd have to go back and look at their actual numbers to see what's going on, what the reason was for this dividend cut. But $1.25 in 2023, raised it up. So they're back to raising it. 2024 up to $1.30. Again in 2024, raised it up to $1.40. December 2024 up to $1.65, and then back down to in 2025 to $1.55. Most recent it was $1.55. So it actually looks like they just have sporadic jump up. Are these special dividends? March, June, September, March, June, September. No, that's their typical payout. So It may be that they are paying dividends based out of their free cash flow and just wherever they're at that particular quarter, they're adjusting because they are a bit up and down 140, 165, 150, 150 to 125. Uh, I mean, overall, it looks like over time they're going up 150 into 2022 to 155 in 2025, but I don't like how sporadic they are where they go from the 130s, 140, 165. I'd like to see a little better management in their capital to where they're just increasing the dividend over time. Now, this where they're increasing it multiple times a year, that is nice to see. 140 to 165, then back to 155. But overall, like I said, I like that they're rewarding shareholders, but I don't like the sporadic nature of their payouts, up and down, up and down. All right, let's run it through the screener. Understand the business, right? They're a REIT, and again, you've probably seen some of their billboards, some of their advertisements, and not even known it, right? They're billboards, buses, bus benches, that sort of thing on the side of buildings. Growing free cash flow. Nope, we had the one down year. Growing dividend. Yes, double-digit dividend growth. Dividend payout ratio, and I'm assuming that 20% is impacted by the multiple raises in 2024, actually. Dividend payout ratio of 75% or less. No, it's well above 100. Check valuation based on dividend yield theory. Dividend yield theory says they're potentially undervalued. It is not quite within 15% of a 52-week low. Again, needs to drop under $14 or $114.80 per share. Return on capital employed just under 10%, very close, but not quite there. Earnings per share growth was not listed. Now, it only gets 3 out of 8, so typically this would not make it onto my watch list, but I'll be honest, I am interested in looking at the financials of this company only because it's one that Warren Buffett added to his portfolio, and it's a REIT, and he does not typically have REITs. The Berkshire Hathaway portfolio does not typically have REITs in its portfolio, so I am probably going to do a deep dive into this one anyway, but typically this one would not make it onto my watch list. Only 3 of 5 or 3 of 8 there, and it needs to be 5 of 8. So interesting company, being a REIT and in Warren Buffett's portfolio or Berkshire Hathaway's portfolio. I probably am going to do a deep dive into this one anyway, and I do appreciate the recommendation, Jeff. This was one that jumped out to me whenever I looked at the most recent 13Fs. This Nucor, UNH already held in my portfolio. Several others that he recently added to his portfolio jumped out in the most recent 13F, so appreciate the suggestion. All right, that is it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of Lamar. Is it one that you are buying? Is it one you're selling? Maybe you were part of the downturn today. Is it one you're just holding and waiting for more of a pullback? Would love to hear from you in the comment section, and let me know what you think of the video. If you have a suggestion like Jeff did here, drop it in the comment section. I'll try to work it into the rotation on the day it pulls back. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey of educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or see the advice counsel of a certified financial advisor. Thank you to those who made it to the end. Watch time is one of the metrics that the YouTube algorithm looks at. And if you know anyone who is an investor, a dividend growth investor, who might enjoy the content, go ahead and share the videos and hit all those buttons on your way out down below. Thank you.